Oil prices took a sharp dive, dropping more than 2% after a disappointing U.S. jobs report shook investor confidence in energy demand. But here's where it gets controversial. While the market braces for a potential surge in oil supply, the geopolitical tensions and production decisions by OPEC Plus add layers of complexity that many overlook. On Friday, Brent crude futures closed at $65.50 per barrel, down $1.49 or 2.22%, marking the third straight session of losses. Meanwhile, U.S. West Texas Intermediate WTI crude ended the day at $61.87, falling $1.61 or 2.54%. This decline reflects growing concerns about weaker demand and rising inventories. A key factor behind this drop was the latest U.S. jobs report, which revealed a much slower pace of job growth than expected. The Labor Department's Bureau of Labor Statistics reported that non-farm payrolls increased by only 22,000 in August, a stark contrast to economists' forecasts of a 75,000 gain. This sluggish employment growth signals a potential slowdown in economic activity, which typically reduces energy consumption. Adding to the bearish sentiment, U.S. crude inventories rose by 2.4 million barrels last week, defying analysts' expectations of a decline. Higher stockpiles usually indicate weaker demand or oversupply, both of which can weigh heavily on prices. Looking ahead, the oil market is closely watching an upcoming OPEC Plus meeting scheduled for Sunday. Sources indicate that 8 OPEC Plus members are considering boosting production further. This move could flood the market with additional barrels, intensifying the supply glut and pushing prices down even more. Phil Flynn, a senior analyst at Price Futures Group, described the situation as a perfect storm, where disappointing economic data and potential production hikes collide to pressure prices. OPEC Plus currently controls about half of the world's oil output. The group had previously implemented output cuts totaling approximately 1.65 million barrels per day, roughly 1.6% of global demand, to stabilize prices. If they decide to reverse these cuts prematurely, it could exacerbate the oversupply problem. Commerzbank analysts warned that any new production increases would likely exert significant downward pressure on oil prices, given the already existing risk of surplus supply. However, the story isn't just about numbers and forecasts. Geopolitical factors continue to play a crucial role in shaping the oil market's future. For instance, U.S. President Donald Trump recently urged European leaders to halt their purchases of Russian oil, aiming to tighten sanctions and reduce Russia's influence in global energy markets. Such moves could disrupt supply chains and potentially push prices higher if Russian exports are curtailed. J.P. Morgan analysts highlighted the ongoing risk that Western powers might escalate sanctions against Russia to pressure President Vladimir Putin into negotiations. Yet, the recent public display of solidarity between Putin, Indian Prime Minister Narendra Modi, and Chinese President Xi Jinping at a Beijing parade suggests a defiant stance against U.S. demands. This alliance hints that Russian oil will likely remain a significant part of the global supply network, complicating efforts to isolate Moscow economically. John Kilduff, a partner at Again Capital, emphasized that the weak jobs report is a negative signal for the market, reinforcing expectations that the U.S. Federal Reserve might consider cutting interest rates to support the economy. Lower interest rates typically encourage economic activity, which could eventually boost energy demand, but the immediate reaction has been cautious. So, what does this all mean for oil prices going forward? The interplay between economic data, OPEC Plus production decisions, and geopolitical tensions creates a highly uncertain environment. Will OPEC Plus prioritize market share over price stability by increasing output? Could sanctions on Russia tighten enough to offset the supply surge? And how will the U.S. economy's health influence demand in the coming months? These questions are far from settled, and they invite debate. Do you think OPEC Plus should hold back on production hikes to support prices, or is regaining market share more important? How much weight should geopolitical risks carry in price forecasts? Share your thoughts and join the conversation below. Because in the world of oil, every perspective counts.